Hello, everybody. This is Chris. It's happy spring month, March the 6th. Hope this finds all of you well. Thank you for joining us on this month's Connect Series webinar. It's amazing how fast months can fly. We'll try to have some fun today, and just to let you know, we're going to try something new to reward the people that are on the call. We're going to have a couple of giveaways. They'll come up in a couple of surprise spots. Nobody should get a headache over the questions, but we're going to give away a couple of Amazon gift cards. So anyway, thank you for all that are being here. I know a lot of people listen to this afterwards, so thank you for your membership. We've had a very humbling number of new people that have signed up with us, and we're really excited to work with you for months and years to come. So let's just go ahead and get started. Just kind of want to always kind of start off with some of the same things as a reminder. My intent is to try to follow Occam's razor. If you're not familiar with that, it's just the idea is how can you come to the best quality decision with the least amount of noise. Essentially, that's my paraphrase. I hope to show you a pattern that all of you are busy in your lives, that you can look at it, see what we're talking about in 30 seconds or less, see why we advocate it, which direction we think it'll go, and also from a risk management perspective, where the stop is. So we're trying to keep things simple, keep things fun, and keep things efficient. And also we're trying to keep our bias hat in the drawer. We continually try to reiterate that we're not a bull or bear on the market. We believe that being bullish or bearish is nothing more than a psychological state of mind, and so it's not a strategy. And so we're all about strategies. I don't want to see the market goes down, but if it does, it does. So as we shared with most of you a week or so ago, some ideas on capital preservation. So we have game plans for however things unfold, whatever billions of free-thinking people decide to do. So just got a few charts in here from good friend Ryan Dietrich. Thank you, Ryan. Just to I thought this was an interesting one. This is, if anybody saw the webinar this past month on multi-decade opportunities. This is my anniversary month, or February was, excuse me. It was my 38th year in the business, starting it. And just kind of looking at long-term bull markets here, and this is a chart of the longest lasting bull market since World War II. And the gray line happens to be the longest, which is October of 90 to 2000. And the next longest is the one that we're currently in. So even though we had a quick retreat in the market, one of the quickest 10% declines in history that we've witnessed, the trend is still up, but we can see that it is close to one of the longest in history, and the longest is 10 years. So we're now within a year of the longest since World War II. As a reminder, since we're started at the first of each month, I like to try to remind people of seasonal patterns, and we're going to speak about a 2-month seasonal pattern, or 60-day window. This is the look of how the S&P is done in each given month, again from good friend Ryan. And how it's done, the blue is how the S&P is done since 1950. The gray is how it's done in the last 20 years. And the yellow is how it's done in the last 10 years. And so you can see that the last 50 years, from the longest term perspective, it's still really good months. But when you look on the aggregate in the last 10 to 20 years, March and April are essentially the strongest 60-day window of the year. Maybe it has to do with spring break and everybody feeling good, March Madness, whatever it happens to be. But this is a historically positive time of year. When we talk about the Santa Claus rally, you can see off to the right side of the screen. This is even stronger than the end of the year, 60 days of November and December. Just kind of wanted to update from real quickly on a sentiment perspective. I'm not going to spend gobs of time in this month's webinar. I'm trying to keep you up to date in the weekly reports. But kind of what's the thumping last month done to sentiment of the average investor out there? And this is the CNN, USA Today Fear and Greed Index. And it's done a lot because when you look a month ago, roughly, when we did our webinar, the market has started to turn down. I think, I apologize if I'm wrong on the date, but the first Tuesday in February, I think it was around the 6th or the 7th. Forgive me on being incorrect on the date. But the market had already started to go down. For all of you that were members, you know, we dipped into the market on Friday, February the 9th in Apple and Google as the S&P was hitting rising support, and so were those two tech stocks. We picked up some gains on those, took some profits on Google, and still have Apple now, and I think it's up, I don't know, 12, 13% since the purchase. But I guess the thing that sticks out to me is there's a lot more fear than there was in this survey roughly a month ago. A year ago, obviously, it was the greed factor was even higher, and so this is something that you know, we got to keep in mind that that quick decline has definitely taken the edge and some of the confidence or cockiness off of a lot of investors. One of the things I try to start off each month's webinar, and you know, if somebody was to ask you, if I was to ask you, if you could just look at one or two charts, what would you look at to tell the condition of the market? And I know we could all have different answers, and I'm not saying mine's right, but if somebody asked me that, Chris, if you could just look at one or two charts that could really tell you a ton about how the market's doing, the advanced decline line would just be at the top of my list. And so the next two charts are going to be the advanced decline line on the NYSE index, and the next one's going to be on the Nasdaq. So if you're taking some notes or just mentally looking at this, I want you to kind of think about as far as hard charging and then pause. And what do I mean by that? So if you think about all the 2009 low, you know, the advanced decline line had been declining. I didn't draw a support line in here, but if you arbitrarily draw one off the 2009 lows, 06, you can see it broke support. We had the financial crisis. A lot of markets really suffered. This was telling a lot that the average stock was declining, or there was more decliners than advancers. But then you saw this big surge. But then what did you get after the surge? You know, CIB caught its breath. And it caught its breath for a while, you know, over a year, almost 2 years. And then what did it do? Got another surge again, just charged hard, sprinted up for a couple more years. And then what happened? CIB again, catching its breath, caught its breath for almost 2 years again. So I want you to make note of 2014. So we had a top of the rising channel and the AD line still moving up. We had a steep support line coming up, and then once that broke, you see the AD declined, and you can see at the bottom of the time, it was a decent period of time, almost a year, and it took it down to really put a huge test. Actually, it was a throw under of this rising channel here. And then what did it do? Boom, another hard charging rally for a couple years, taking it back to the top of the channel. So if you've been around, you know, a while, we have just members of many, many years, and we appreciate and humbled by that. We also have new people. So anybody that's new, just want to remind you, this has been something we've been publishing every week in the global dashboards, or global trends report. We will continue to do that. I think this is extremely important. We have what's been a key message over the last 90 days. It's been that this advanced decline line is sending a bullish message, but it's also at the top of this rising channel. And I'll say it several times, but this is a place where bulls do not want to get selling to start because of where it is and the steepness, the length of time this has taken place. And it would give a short-term cautionary message to the bulls if this rising support would break right here, as it did in 2014. So the trend still remains up. The decline that we've and the choppiness that we've had of late has not changed the trend. Bulls would get a cautionary message for sure if this support would break. So I don't know if you noticed, but I changed screens on you. This is the look at the Nasdaq. You can see some similarities. You can see this hard charge off the 2009 SIB moment, caught its breath for a couple years, hard charge. And remember, again, write down the year 2014, because we're going to revisit this a couple of times. Then what do we see as a support break? We see this SIB moment again, catch its breath for a while, and hard charging. So the Nasdaq is also continuously in a bull trend. Nothing of late has changed tech's trend. If anything, tech still remains stronger than the broad market in general. And tech, just like the NYSE, would get a caution message if rising support would break. So one of the reasons that I've tried to hit hard over the last several months about this is a place where bulls don't want to see selling get started. This is essentially a 100-year snapshot on the Dow. And you'll notice, if anybody happened to see the webinar, I shared with how we try to build charts and how we try to look for tops by first looking for bottoms. So what I did, this is a monthly chart. So anytime that there is a low point, keep in mind that it may have taken a while to form because this is a monthly chart. But if you'll notice, there was a low in the early 40s and the late 40s. And then right here as a junior, I was a junior in high school. President Nixon gets impeached, 50% decline in the S&P. So you notice, what if you started just creating, we got this rising trend going on. I just got my securities license in 1980. The Dow dipped below 1,000 right here in 1982, in the summer of 82. It hadn't went anywhere in 15 years. The only place it had went was like a rocking chair. It was just keeping people busy, rocking back and forth and going nowhere. But this is definitely an ascending series of rising lows. Do a copy paste to try to look for parallel emotional trends. That's what we're looking at, folks. So we're going to try to find highs by finding upset points or lows. So if we would copy paste this, you can see that this middle line is also a parallel line. You can see that it rallied off the 82 low, ran into 1987, had the quick 87 crash, kept bumping along, got above it, used the old resistance, new support, and there you have the roaring 1990s. But also what intrigues me is you do another copy paste laid on top of the high in 1929, and lo and behold, the market hits it in 2000, doesn't hit it, gets near it in 2007, and we're back at it. While we're back at, or the Dow is touching the top of the 70-year channel, the top is monthly momentum. It takes a long time for momentum to get up there, and it doesn't just change on a dime typically. You can see when momentum was really oversold, it was a good place to buy after the Nixon impeachment and the financial crisis. Momentum is lofty right now. It's only been up here a few times. And the key things that stuck out to me is right now it's higher than 2007. It's at the same level as 2000. It's at the same level as 1987. And it's at the same level of 1929. So this is why I've tried to share for several months. This is not a place where the bulls want to see selling get started. And I've never once tried to say this is where it will get started. You know, the trend is still up. Nothing has changed it. But this is a place where we have to think about preparations, to be on guard, to be a little more vigilant, to raise stops, potentially be more protective in case some selling takes place up here. Now, the best thing for the bulls to be is what, everybody? Boom, just nothing more than a simple breakout, you know, or a continuation of trend. And nothing's proved that that's going to change. But as I'll just keep boringly say, this is a place where I'm going to be very mindful if selling or further deterioration would happen to take place at the top of this channel. Bottom line, this image, this is a bull up for sale. You don't want to see the bullish case. You don't want to see selling take place up here for the bulls. So, you know, Gomer Pyle used to say, surprise, surprise, surprise. And so when I ask you to write down a number on the advanced decline line for the NYSE and the Nasdaq earlier, the year was 2014. So it was hitting resistance at that time. So this is the VIX index. And so if you can only imagine the market's just steamrolling, just doing really well, what typically does the VIX do? It falls to a low price. So it happens to hit those AD lines. It happens to hit the top of that channel. And then what happens to the VIX? Shoots up with this big rise in the VIX. And then it comes back and it stays low for a few years. And then boom, we have this rocket ship last month. So here was when it was hitting 2014. There was a lot of peace of mind. You see it was the lowest in the VIX since 2006 or 7 right here. That's when the Nasdaq and the NYSE was hitting the top of that resistance. And then by the time, remember how we said it took a SIB moment for a couple years. And so then the AD line went from the top of the channel to the bottom. And when it was hitting the bottom of the channel, what was the VIX doing, everybody? It was spiking at the same time. So we had a lot of fear. So then from 2015, 16, now the market's just been rocking and rolling to the upside. As we all know, fear just disappeared. Everything was fine, short volatility, and then last month all of a sudden, bam, it skyrockets back up. So again, this is what we've tried to, we want to try to be under the, if any of you heard kind of the Boy Scout motto, to be prepared. I don't know, humbly everybody, what billions of free thinking people are going to do collectively. I believe these chart patterns are nothing more than all the knowledge on the face of the earth by these billions of free thinking people, and they can give us clues because people tend to repeat things emotionally. Bottoms are opportunities to find highs, and highs are opportunities to find bargain buy points. So let's use those emotions of the collectiveness of the whole world to your advantage. So I found some things really interesting, some things that Ryan had said past February 5th. I'm going to read through a few of them. So Ryan on February the 5th points out, wow, we just had the largest VIX spike ever, up 115%. I believe it was in a day. Dow's down 1,100 points, most ever. Dow's down 4.6. This was the 112th largest drop since 1896. 404 days without a 5% correction, it's over. That was the longest ever. 403 days of positive year-to-date returns, over. That was the 5th longest streak. Now, all of that, when did all of this take place? When that VIX was extremely low and the Dow was hitting the top of that 70-year channel with momentum overbought. What else took place? Ryan said on January the 26th, global equity funds break the inflow of the record last month. And by February the 1st, equities saw the biggest monthly inflows on record. And then, holy cow, by the February the 9th, U.S. leads record 30 billion of outflows. And on February the 9th, Dow posts the worst week in 2 years. Then he says on this, as of last night, the Dow has moved 2,600 points, absolute value. That it's only 5 days of trading and is greater than any single month all of last year. The S&P 500 closed up or down 1% for 3 consecutive days for the first time since September of 2016. And it hasn't been, and it's made it 4 days in a row since the Brexit late 2016. Steve Burns shared that was something of Ryan's. This is the first time in history that the S&P went from a new all-time high to 10% correction in 9 days. The last time the S&P was up 5 days in a row, with 4 of those days greater than 1% or more, and never closing beneath the 200-day moving average, was October 1982. It's happened yesterday. Today's the second time in a month the S&P 500 was up 1% at one point and finished down at least 0.5%. August 2011 was the last time this happened. More proof we aren't in 2017 anymore. The S&P 500 closed down at least 0.5% 8 times over the month. That's 8 times in a month, and it only did it 6 times the entire 2017. And the last piece I'll read here. Today will end the record 15-month win streak total for the S&P 500. And here's a graphic of that. So folks, we've been trying to say, be prepared. This is where you don't want to see selling get started. Try to be on guard. We tried to raise our stops. Some of that time frame, there's some really good hedge funds out there that just have gotten the heck beat out of them this year. And so we're going to spend just a little bit of time on this. Todd's been a great member, a great friend. Appreciate you attending, Todd, and participating. This is the Dow. We're going to go backwards first, and then we're going to fill in why I agree with Todd, or why Todd, not that he has to agree with me, but why I feel the 261 was a big influence. Because I think the 161 was a big influence. So one of the things, if we would look back over the last 12 years, we'd say, hey, from an emotional perspective, when was society the most giddy as far as the stock market, and when were they the most scared? Well, to me, the answer would be they were the cockiest, the giddiest. Euphoria was the highest at 2007 high. And the flip of that, when were they the most emotional and the most scared, was a 2009 low. So I continue to put this into the global trends report each week. But what we did was we applied Fibonacci to the monthly keyword, the closing high in 2007 here on the left, and then the closing low in 2009 here. And so, you know, if you're not familiar with Fibonacci extensions, you know, but a couple of the key numbers in Fibonacci are 38%, 50, and 61%. And so what the extension level did was it took this distance and added another 61% to it, hence 161. And so you'll notice that when the Dow came up and hit this level, what did it do, everyone? So, you know, charging hard, did it do a SIB? It caught its breath for a while, right? So it caught its breath for about 20 months. But you notice it kept banging up there, didn't fall apart, came back close to it again, came back down. Some might say, wow, that's a W bottom. Yeah. Came back up and banged on it, and then look, it broke out. And what's the ideal situation for a breakout? You know, sometimes when assets break above a resistance line or old highs, sometimes they never look back. Sometimes the most ideal situation, everybody, is to break out and come back and test old resistance as new support, which it did here, and then a rocket ship. 50% rally. We're almost to what, Dow 18,000, runs up to almost 27,000. What's half of 18, everyone? Just from a round number is 9,000. 18 and 9 is 27,000. So almost a 50% rally. Boom, right out of that. So the 161 level was important, but let's go back to the earlier slides. When did the NYSE and the Nasdaq hit the top of their rising channels, folks? I asked you to write down the number earlier. It was 2014. So you'll notice not only did the AD line hit their rising channels in 2014, so did the Dow. So maybe we had a double piece of importance. Could that ever come into play again? I think so. But what was this 161 level for 20 months? It was a blasted wall. It was a wall of resistance. And it was a great wall for quite a while. And so if somebody's impatient, you know, you can get frustrated. This is you know, every good strategy has its weak points. If you run into a wall for a while and you're using moving averages or momentum, this is one place you might want to back off from, because about the time you get this sell signal right in here, all of a sudden it's close to a bottom, and oh, I got to get out, and then it starts going back up, and oh, I got to get back in, and then all of a sudden I got to get back out and in, and it's turning people into sausage, just grinding them away. So these are periods to realize the strong and weak points of any strategy, particularly of momentum or moving averages. If you look back, that's a tough time window, and then it became a good window. Once it broke out, you know, hey, just hop on and ride. But this was a big wall. And so I've tried to build this case, everyone. This is the same chart that we just looked at, the Dow, and here's the sideways motion for almost 20 months. And there's the advanced decline line that we looked earlier that was hitting the rising channel, went sideways for a good period, and then it hit support. This is where the VIX was low. This is where the VIX was high that we shared earlier. So there's pieces, puzzles that come in together of repetitiveness. So I want to share that, you know, right now, back when I first got into this business, Reagan said in the early 80s, tear down this wall. So what we did here was we took the Dow and we did the same thing. We took the Dow and applied it to the 2007 highs and the 2009 lows. These were the numbers that came into play. The Dow hit 14,198 as a high in 2007, a low of 64.69 in 2009. But this time we applied the 261 extension level. For old members, you know, we've been sharing this month after month after month for, I don't know, it's almost going on maybe 2 years, that this was an upside target, that if it was hit, we want to be really aware of things. And so it amazes me. This has nothing to do with Chris whatsoever. This This stuff has amazed me, folks, for 38 years, and it never ceases to let me down. But you'll notice, where did a reversal pattern, or where did the Dow stop on a dime? As Todd said earlier, it was the 261 level around Dow 26,700. And so what I want to first off build the case is, with the advanced decline line hitting the top of its channel and this potential wall of resistance up here, until it's broken, it is a wall of resistance. One of the first things to be aware of is we could be entering a sideways choppiness. Not bullish, not bearish. CBS Market Watch wrote an article. It was a good title, much more creative than I can ever do, but said something along the line, is the market going to skyrocket, or is it going to crash, or is it just going to go into a deep freeze for a while? And it was about this angle. And so until resistance is taken out, the wall's up there at 26,700, everybody, and support then comes into play around 23,360. So you can see that's I think roughly around 13% range from high to low. So could this apply to the S&P? Well, let's just do the same thing. This is not the same slide, everyone. This is the S&P, and I applied Fibonacci to the, as I say in this box right here, the monthly closing high in 2007 and the monthly closing low in 2009. And what are the chances, everybody, that the S&P ran right up and kissed that 261 level and stopped on a dime and did a reversal? So until, this is SPY, until SPY can take out 285, we got a wall up here, wall of resistance. And don't, just because the last time it was here, folks, and it lasted 20 months, don't go down the path that, oh, we're gonna have another 20 months sideways. We don't know. But right now we have resistance at 285 and support at 252. My key is, don't be surprised if we chop around up in here, folks. And some people, oh, the bull market's over, and oh, the bear market started, or whatever. I don't know, folks. Right now the trend is still up, and don't be surprised if we see some choppiness in here. And this is a time where I'm going to take smaller positions and not try to do moving averages or momentum strategies until we see some type of a breakout. Because if it would chop sideways for a while, that's probably one of the most challenging strategies you could use. So what I'm trying to do, folks, is get you prepared. And this is an example of one of the most magnificent, if you want to use a term like that. I think it's magnificent when it happens, long as it doesn't hit you, of the storms on the earth. It's a tornado. And just to let you know, this is a map of the United States. I'm coming to you from this black dot from Salina, Kansas. And that red shaded area is what they want to call Tornado Alley. And so what I've tried to do over the last many months is to try to talk about conditions. And so I just turned 60 this past summer. I've lived here all my life. And I can assure you, roughly between this month, March, through the summer, if I open the door and I go outside, there's certain conditions that I don't even have to watch the weather that I know I better have a heads up. And it's when certain ingredients are taking place at a certain time of the year. And what are those? Well, for us, this is what's important in Tornado Alley. So just kind of bear with me for a minute, but here's Kansas right here in the middle. And this yellow orangish line, that's that presumed Tornado Alley. Everybody draws it differently. But it's the conditions that have to take place first to possibly have a storm and to know when to take action. We need a combination of warmness, so it takes at least in March, April, some warm air that's coming up from Rick's down there in Texas now, and he's pushing hot air up our way. And then there's this cold air that's coming in from the Rockies. And so you got a collision of a cold and a warm front with the jet stream coming through here. And when all those conditions are there, you have a greater increased likelihood of a tornado. But let me ask you, does every day that these conditions take place, does a tornado happen? Absolutely not. Just because the conditions are there, it doesn't mean a storm's going to take place. Now, June of 2008, the conditions were ripe. We knew that they were. And I'm not embarrassed to say I can't do anything about it. I have sleep apnea. And so a couple of important things in my life outside my family is my sleeping machine and my computer to work for you guys, to try to stay on top of things. And my wife sees me heading down to the basement. What are you doing, hon? Well, the conditions are really ripe. I'm going to protect a couple of valuable assets, and we should go and follow. Well, by the end of the night, short story made long, we're in our basement. We go to leave the basement. We can't figure out why there's water running through the roof or from the ceiling down below. The carpet's all wet. And you know, oftentimes in a basement, you have some stairs that go up, and then there's a 90-degree turn. And as we got to the bottom of the steps to look up, we thought, why is our chandelier from upstairs down sitting on that level? And as we looked up, we could see the sky. Roof's gone off the house. We were fine. Material stuff can be replaced. House is totaled. But the majority of the time, folks, these conditions take place, we don't have a storm. And so my goal is that I want to talk to you about conditions. And, you know, to some of you that, you might have seen this past week, and we're going to spend a few moments on a condition. Doesn't mean anything's going to happen, but you got to know the conditions, and you got to know then a game plan if these conditions would come true. So we're going to discuss. I threw it all out to you last week. It was, to me, very important. Was this pattern called a hanging man. And so if any of you have a piece of paper, I'd like you to make a little dash, just left to right, horizontal on a piece of paper. And then on the right side of that dash, just draw a decent long line. And then on the right side, put another dash so it almost looks like a plus sign here. So the left dash would represent when an asset opened up in price. Now this could be daily, weekly, monthly. It could be an ETF. It could be the S&P. It could be the Dow. It could be bank stocks. You name it. But the point is how a hangman, how does it take place, and why is it important? So you open at a high, and preferably at an all-time high, and then something happens and you sell off. And then after you sell off during a time period, guess what? It rallies back. And so the notch on the left and the right side are close to each other. In other words, it opened and closed close to the same price, but it had this long body there. And this is called a hanging man pattern. And so for whatever reason, many times, folks, some of the most important highs or tops that have taken place in key markets have this little quirky pattern. And now we're going to go through the conditions, but just because the conditions are there doesn't mean there's going to be a storm. But if there is, my whole goal is, what's one of the things that Chris is trying to do for you? He's trying to empower you, trying to educate you, not trying to scare you, trying to prepare you for opportunities. And that's all it is. As I've said many times, I didn't name my company Kimble Charting Problems. The name of the company is Kimble Charting Solutions. And so my job is to find these situations, empower you so that you can see what might I do. Just like when you heard me saying earlier, I headed to the basement with my important things. What might you do if some of these patterns come true? So I want to just go back and share with you, I've hardly ever written about this hanging man pattern, folks, because it happens so rarely. But when it does, it's kind of those ringing of the bells. Hey, pay attention. So this is the S&P on a monthly basis over the last 14 years. Anybody see a hanging man pattern anywhere? Well, let's just kind of look right here. Let's go back to the 2007 high. So we can see this just came from right down here, folks. But if we highlight it, it's going up, it's going up, it's going up. And then you can see that it started off the month at a high, sold off, and came in close to there. And so this is where this pattern took place. And lo and behold, that's when a large decline started. And every hanging man is not about a large decline, but they can happen. We see a similar pattern here. The ideal hanging man would be a little bit higher, up there. But I just want to kind of share what took place in February. And folks, maybe it was just perfect timing, because remember, the market, when did it start declining? It finished the month of January almost all the indices at a high. And then the selling, it opened up at a high at the 1st of February, and then the selling took place right away. And then we had the sharp rally back. So maybe it's just a quirk. Maybe it means nothing, that it just happened to be the fate of how a certain month turned out. And it could be nothing more than that. But you can see that we have another large hanging man taking place this past month near all-time highs with momentum that's very high. And so, you know, in hindsight, we can all look back for these patterns. And the thing that got my attention and why I'm willing, you know, folks, if you're bullish, this isn't, you know, I'm not hoping for any decline. I hope you can look back and say, God, you know, Kimble wasted my time talking about that stupid hangman pattern. And I'll tell you very humbly and honestly, I'm fine if that happens. What I wouldn't be fine about is if I saw this and I kept it in my back pocket and then something happened and you weren't aware of it. So I'm willing to go to the confessional booth, say this is here, and then we'll see how it unfolds. So the thing that also got my attention that I shared with all of you in the weekly reports, this is the bank index, the BKX, going back to the 2000s. If we look close, what took place at the 2006 high before the banking crisis started, here was a hanging man. It was at a high, you see this reversal, and it was right here, and then we see what happened. And then it intrigues me that here we're back at very close to 2007 highs. So right now, that's a form of resistance. Could it be a double top? Yes. How do you end this pattern? It breaks out to the upside. If it breaks out to the upside, again, this is a wasted conversation, which is fine. But there was this potential of this hanging man that took place in the month of February. Not only did the same pattern take place in the banks at 2007 highs, this is the Nasdaq Composite. So let's go emotionally. And remember, we've talked about you can find highs by first looking at lows. So if we take the monthly lows in 2003 and 9, copy paste that line on top of the 2000 high, and lo and behold, that's where the Nasdaq is. Here's this quality rising channel that's been in place for 8 years. Here's another quality rising channel that's been in place for 2 years. So we have a triple breakout test and then a potential hangman. So again, the easiest thing to keep this trend going is just to bust above all three of these resistance levels. And the hangman's a wasted conversation with you. But this is be a place where the bulls would not want to see selling get started. So this is why I think, again, being empowered and being prepared of what's taking place here to have game plans. So this is the transportation index. And so I look back and, you know, it's hard to believe that the transportation index in the last, 6 years has had 29% declines. We see a hanging man here and a 29% decline. We see a monthly hanging man right here and a 29% decline. And we see a monthly hanging man last month at 2. So there's a few of them out there, everybody. So I sent an email early last week, roughly around a week ago, that I talked about that it could be time for capital preservation. It was all in trying to build up and talk about just being prepared, game plans. Nothing was to be done yet, but just I don't want you to be caught by surprise. So this is a good friend of mine for 20 years, and we're at a K-State Texas A&M football game and it's raining. So some people can go and not be prepared. And then there's other goofballs that are prepared. This is yours truly. You know, I wasn't getting wet. I tried to be prepared. Actually, that goofy thing on my head, my seat cover off my chair. You know, and so this is what today is about, is being prepared, being empowered, understanding what takes place and what might you do. And so earlier we talked about how you can build long-term charts by looking for emotionality. The top chart's the Dow, the bottom chart, the Dow over 100 years plus in the top chart. This is as far back as I can get the chart on the 10-year yield in the lower right. And so all I did was just take the lows and try to find channels and see if those lows had anything to do with emotional highs. So here's the first, you know, the channel that we looked at earlier in the Dow. Here's the falling lows, and then I just do a copy paste. So you see a couple of very uniform long-term channels that are taking place. 70-year on the Dow and the 25-year on the 10-year yield in the lower right. Both of them are testing resistance at the same time. Now, I don't know, everyone, what's going to take place. I don't know, especially in the lower right, if yields bust to the upside, is that bullish or bearish? We'll just see what the world does with it. If it breaks to the upside, maybe that's a good sign of economic strength. Maybe that leads to good commodity plays. If yields back off from here, the last 2 times they were here was a couple of important years. And here's the same chart, just with a little bit of different noise on it. When yields were at the top of this falling channel in 2000, we know where the Dow was in 2000. And then lo and behold, from a repeating pattern, folks, in 2003, when yields were at the bottom, that was a good time to buy the Dow. And then they rally back up and they hit the top of this channel in 2007. We know that the Dow backs off, yields come near the bottom in 2009. So this is a good time to buy bonds, good time to sell bonds, good time to buy bonds, a good time to sell bonds. And now we're back up against this rising channel while the Dow's up against 70-year resistance. And so, last couple of weeks ago, time has flown. I think a lot of you have seen our webinar. I just felt like times were so important. I wanted to reach out to the world. When I had my financial planning practice, one of the questions, to Sir John was, and I started sharing all my technical analysis. I said, Sir John, what should I do? Keep my practice or try to serve the world's community? I can't do both. I'm not enough of a man. And he said, Chris, God's going to put food on your table. Either way, you do the right thing, he'll do that. The question is, do you want to serve a couple hundred people or do you want to serve thousands? I chose the latter, to try to serve thousands. And so a couple of weeks ago, I did the webinar on potential multi-decade opportunities at hand. I believe, folks, we're looking at multi-decade opportunities. These puppies are going to give or hold, and they're going to create great movements that it's going to lead to really good opportunities for all of us. We don't have to outguess them. We'll just see if it's resistance or they break out, and we'll just follow with the flow. So I always try to keep an open mind to opportunities. I think there's nothing more that's dangerous than to have this long-term mindset. In my 40 years, the people that I've seen blow up the most had this giant roadmap. This is exactly what's going to happen, or the market's going to go down for a few years, and it's going to rally for a few years, and they stuck to it, and it went against them, and they blew themselves up. And so I would encourage you, this is something that I'm not going to do. I'm just not even smart enough, folks, to know. I'm not sure what I'm having for supper tomorrow night. I apologize for that, but I'm not sure. But to try to guess, like the beginning of the year, oh, this is where the S&P is going to be, and yada, yada, that's just above my pay grade, folks. But I think you got to keep an open mind and listen to the chart patterns of the world. It's like this gal down here, she just looks a little stubborn to me. And I want to try to encourage people to stay away from it. And so we're going to talk about, just for a second, like a wily coyote. He always kept trying to capture the Roadrunner, and he was always blowing himself up. So how can the Hangman patterns be blown up? Which they can. And it's really simple to blow up any concerns. This is the semiconductor index that we've highlighted week after week, month after month. That it's a leader. It's up 50% more than the S&P from the 2009 lows. And it's testing its 2000 highs. The line 1 here is created off the 2000 highs. You can see it's trying to push above that. It's been in this quality rising channel for several years, and it's trying to break above that. So one of the easiest ways to blow up the Hangman, you see a big Hangman right there. Semiconductors weren't able to escape that same pattern as well. So, but if it breaks out to the upside, folks, the bulls can probably wipe the sweat off their brow. Hey, Kimble wasted time. Those Hangmans just happened to happen, but it's not meaningful at all. But again, this is a place where the bulls don't want to see selling get started. But I just want to make sure that I'm to you, all of you, guys and gals, we're open-minded and flexible, and nothing is proven so far. One of the we've got a hedge fund manager out of New York. He sent the other day. He said, "Hey, Chris, I saw the March and April are historically strong months." He said, "If you could just pick one ETF, what would it be that you'd want to be long if things come out seasonally wise?" And my answer is XLK. So this is the tech ETF, and this is on a weekly basis. So you can see a couple year rising support remains in play. You can see some level tops, and there's a potentiality this is a bullish ascending triangle. 2/3 of the time, this leads to higher prices. So tech has led the broad market. Semiconductors have led the broad market for several years. If semiconductors break out, XLK breaks out here, I would encourage you to hop on board that. And that was one of the reasons that on February the 9th, shoot, it's hard to believe that's a month ago, why we went in and suggested to buy Google and Apple. You know, we could have suggested to buy the S&P and there would have been nothing wrong with it. It would have rallied. But the cool thing was by buying both of those, we made a good percentage more than the S&P during that time frame. So in the upcoming weeks and months, I'm going to stick along this theme of Playbook. So, you know, with yields facing 25-year falling resistance, what do we do if yields break out? And what might that mean? How can you play the bonds? What should you be getting out of some of them? And what might some ripple effects be price-wise and some other positive patterns if rates keep going up? Also, commodities, we're going to discuss about that. They're in a 25-year uptrend and they're facing 7-year resistance. What are we going to do if commodities break out? What type of plays might we do? So I'm going to continue to try to build little playbooks that if this breakout happens, here's the type of ETFs that we'll do. If this breakdown happens, here's some of the strategies. So one of the things that we're going to talk about here just real quickly is commodities. This is the chart that I was just speaking of. This is the Thomson Reuters equal weighted commodity index going back 4 decades. This is on a monthly basis. So if you look at the blue rising channel lines, so for the majority of the past 30 years, the index has remained inside this blue rising channel. It kissed it in 07-08, fell hard, came back and kissed it here in 11. Potentially you have a giant head and shoulders top. Outside of whether that's the correct read or not, we do see a series of falling highs and lower lows to where this red, the 2 red lines are a 7-year falling channel. The last time it kissed this was here. It's kissing it again right now. This green shaded area, I shaded it green because this is a chance this is a bullish ascending triangle. Lo and behold, it's now testing the highs for the 3rd time in the last few years at the 23% retracement level of the 2007 high and the 2015 lows. I apologize if I'm wrong on one of those calendar years. Irrespective, it's at the 23% retracement level. It's bang, bang, bang up against 7-year. If it breaks above here, it'll be very positive for commodities. They've been in the doldrums. If you don't like them, I understand why. They haven't treated many people well. But we could see a series of higher lows. And as I said over here on the left, if we see a breakout, you want to have some strategies for oils, want to have some strategies for metals, and you want to have some strategies for grains. One of the things that intrigued me, if you happen to, we've shared this in weekly and also in the webinar, this is the same index. And I don't often look at time cycles, but this was one that caught my eye from a very long-term perspective. It appears that commodities kind of have some 16-year low to high to low taking place, or at least it happened to take place here. Roughly 8 years up and 8 years down. Not a lot of influence to the cycle here, more of a bust, but you did see possibly a low to low. And then we saw this cycle of 8 years of positive and then maybe 8 years of negative. So it's intriguing with me that if there was any validity to the 16-year low, high, low cycle, and commodities are up against 7-year falling resistance, that may be. I've got an open mind here. In some ways, I'd like to see, I'll admit a bias, I'd like to see commodities do well, just because, folks, maybe we could buy something and hold it for a while. Wouldn't that be kind of cool that's been out of favor for years? I'd kind of like that. Maybe it would mean the world's growing, you know, because typically when commodities are falling down, we know the stock markets went up, but maybe worldwide growth has been a little subdued. Maybe that reflects deflation more than inflation. So there could be some positives out of this. So a big test, and this is why I said multi-decade opportunities, you know, could be at hand, and this could be one of the sectors. So I want you to pay attention to this chart because we're going to have a second giveaway quiz coming up. And sorry, Todd, I just created a rule on here. You can't win twice. But this is the silver gold ratio that we share each week in the metals report. We'll share it again tomorrow. And the idea is that if you want to be really long and strong and back up the truck in the metals market, you want to see silver stronger than gold. Now, when this ratio is going up, silver stronger than gold, and it's not a negative on gold. You could own both of them during that time frame. So I want to make sure you understand that. But to kind of send the best of best signals, you'd like to see both of them go up. So you can see that since 2011, it hasn't been going up. We can see that it's peaked here in 11, which is essentially at the top of I'm sorry, I cut this off on the left, but really this is a heck of a trading range. Being high in 2011, this was one of the reasons back then that we thought we made the statement that gold could be flat to down for years to come. And I said that then, and I only bring it up because, you know, in all my thousands and thousands of posts, it's the only time I've ever said something like that. I just believed in it that much. So I don't say it often, friends. And so now we're testing 20-year support. And it's been down here, what, 1, 2, 3, 4 times in the last 20 years, and we're back there again. So, I mean, this is suggesting that, you know, backing up the truck and metals is not the thing to do. Could support give way because the trend's down? The answer is absolutely yes. So there's a big support test taking place. There's potential this is a bullish falling wedge, and it's near the apex of that wedge. And so if it would break out at 3, it would send a positive message to gold, silver, and miners. So we haven't seen the message yet. Actually, it's the inverse. But I want you to be empowered and prepared that if this would break out, it could be a strong one. The answer is actually 225. And I'm not, you know, this was a ballpark. That's why we just said the closest to. But those 4 different support points, which took place, we see a 70% rally here, a 4-fold rally here, you know, roughly from $4 to almost 16. And I didn't try to do the math exactly right, folks. This is just for example purposes. We see silver around $8 rallying up to 50. You know, 8 times 5 is 40. So that's over a 4-fold rally. And even the smallest one, which took place a couple years ago, was a 40% rally. So I'm just kind of wanting to share that, you know, we'll go back those 2 slides, that when you see this ratio this low, you know, and it's held at support, yeah, and it's not the lowest, folks. I mean, obviously it was lower here, and that's a pretty big percentage. So I'm not saying that can't happen, but I want you to be prepared that if this puppy would break out, that some pretty strong rallies did take place. So congratulations, Chris. Thank you for participating. So we're kind of on we'll remain on the commodities theme. We're getting close to wrapping things up. But this is a long-term look at crude oil. We're looking at the last 30 years on a weekly basis. You can see emotional highs and lows took place. We see the highs in 1990, the high in 1999 took place here. You see almost the 2009 financial crisis came down to here, and so did the oil low of around $25 a barrel a couple of years ago took place. So I did nothing more, folks, than took this emotional high and low line. I did a copy parallel, and lo and behold, look how all of those highs fit right up there. Did another copy parallel, and you can see that oil is up against the underneath side of this channel. I mean, you know, obviously this thing was falling hard, and this line didn't even mean second to it, but it just sliced through it, and it just really collapsed and waterfalled after that. So we're kissing the underneath side of that. If we take the all-time high in crude, these other emotional highs and this low, we're also here. So as we shared earlier, if that CRB would break out, I would encourage you to be open-minded to commodities plays. Some people, I mean, there's no, you know, I don't know the risk propensity of all of you. So, you know, a real ballparkish idea would to be, you could almost be a third, a third, a third. Be thinking third oils, third metals, and third grains. We're going to try to be a little bit more precise. Is just whenever the price of the breaks out, the power of the pattern is suggesting to us we're going to go that way, and percentages will work out the way that they do. But that might be something to be thinking about if the commodities index breaks above that 7-year falling channel. This is the DBC for those of you from an ETF perspective. This is the commodities ETF. You can see that It has a series of higher lows from last year. You can see that it's testing what was the lows as resistance here at 2. So to let you know, it's still in the falling channel. It hasn't broken out of that by any stretch, but it is testing. It's getting squeezed here. There's a potential. This is a monthly pattern. If I would have turned this to weekly, we'd see more choppiness right up here, folks, which could make the case for a bullish ascending triangle. This is a monthly chart, so we're just really early in this month. But I've got an alert set that if we see a breakout here, I'm interested in picking up DBC. This is a look at the grains. Long-term trend is down. You can see what's most important to me is this falling line, and this is a weekly chart. And just to let you know that the line is based upon weekly closes. So I drew the line on weekly closes, then converted it to candlesticks, which is high-low close, and you can see a test of falling resistance is taking place. We saw several reversals here. You can see momentum is extremely high, and the last 2 times that it hit the top, 2 out of 3 times, excuse me, you see momentum was lofty here, but it wasn't quite as high as now as it was here and here. So not necessarily a bargain, but I'm still really interested, especially if the broader commodities piece breaks out. If we see US dollar weakness, this will be another piece that we want to be looking at taking advantage if the commodity worm has turned. So like I said, getting close to wrapping up, this is the interest rate 6-pack that I want to continue to share with all of you. Starts in the upper left, going from short to the longest in duration. The 2-year yield upper left, upper right is 5, lower left is 10-year yield, and lower right is 30-year yield. The bottom line, folks, is all of these have rallied sharply the last couple of years. The sharp rally has done nothing more than taken them to the top of their rising channels. If you'll notice, the last time the all-important 10-year yield was at the top of this was 2000 and 2007. So as the Dow is hitting the 70-year channel that we looked at earlier, yields are hitting the 25-year channel. So I don't think this is just some minuscule test of resistance. We can see 2007 here and 2000 in the 30-year. Here's 2007 in the 5-year, and here's 2007 in the 2-year, 5-year, excuse me, in the year 2000. Here's where yields were in 2000, 2009 in the 2-year yield. So all of these hit important tops to this falling channel. And you can see momentum is very elevated in the top part of each of these. So I think there's going to be some great opportunities. I know great opportunities are going to come out of this. And these are some unique tests that I don't care how long that some of you younger clients look at me as some really old guy, and I don't see that in the mirror, but I understand your thinking. But I don't care how long you've been around. This stuff just hasn't happened often, folks. So in wrapping up, with the hangmans, the brick wall, potentially the 261 fib level, be patient, folks. Be patient. As Bill Gates said, patience is a key element to success. Let's just let this stuff play out. Whether it takes 3 weeks, 3 months, a year, just let it play out. Because one of the things that we looked at earlier, if you got frustrated when it hit the 161 level and went 20 months and you gave up on things, you're impatient, you got chopped up and you did stuff that maybe you shouldn't have, and then you didn't follow the breakout, you missed a 50% rise in a couple of, 14 months. And I'm not saying that strong will happen again, but folks, if it gets above the 261 level, I'll show you the next fib target, and you'll be surprised how high it is. So if we would see a breakout, this bull trend would continue. You'd want to be on board. So have the patience. The results will show, just like they have in the past. And I just kind of want to remind you that ranges can drain people emotionally, on emotional capital at a rapid rate. So we're just a couple of weeks after so far the lower high. So if I can do anything, that Sir John tried to pass along was just be patient. This isn't an hour-to-hour thing, day-to-day or week-to-week. We're in this for the marathon, and it's really going to pan out. So the reminder, This was the wall then. 20 months sideways was followed by a 50% rally in 14 months. So this is, again, as I said earlier, my 38th year in this business. Folks, I've never been more excited about this. Opportunities are great. Tools have never been greater, and especially when we're facing these multi-decade channels, stuff's going to happen that you're going to want to be on board when those breakouts and breakdowns take place. So as a reminder, this is our, remember, March is historically strong, and here is our stocks that have done well in the month of March for the last 10 years. The median gain in the month of March is 158, but you can see there's some good performing stocks. Just to let you know, I have all of these in what I want to call layouts with alerts on them. So if we see some positive action taking place, I'll sure let you know. We are on board with CBG. We've liked the way that it looked of all the different chart patterns. It was kind of beat up and was trying to break resistance. So we like that. Somebody sent us an email today about Netflix, that if we bought and sold it in the month of January, and I don't know, 20-25% gains, but it is still acting well. And then one that's on the list that we already own is Apple. Its average gain of 7.7%. Apple has a series of flat tops, everyone, at all-time highs and rising bottoms. It looks to be forming a bullish ascending triangle. If it breaks out above there, I'm going to pick up some more of it. So I just want to say from Rick and I, we thank you for your membership. We're having a lot of fun at this end. I hope that you guys are. Thanks for your new members, your continued membership, and I look forward to speaking with you, each week through the newsletters, and see you next month around tax time. Take care, everybody. Thank you.